Thanks for joining us.
Thank you for inviting me, Wilfred.
So I was reading some of your notes and recent interviews, and clearly you think that U.S. equities are, generally speaking, overvalued, but more likely to continue to rise than fall from here.
Right. Well, let's use the PE first. On the S&P, it's around 23 times expected earnings. Even if you look at the small and mid cap, the 2000 is 26 times, and the 2500 is 27 times. So if you look at any historical norms, valuations are stretched, but we've never seen the long bond at 1.3%, and so we're in uncharted waters here. So higher PEs are justified based on lower interest rates. The other thing is the Fed's going to be highly accommodative. You know, they've basically said they're going to continue to buy $120 billion worth of bonds a year. They're going to keep interest rates low, and so you have the wind to your back. The two unknowns are, one, the rollout and successful effectiveness of the vaccine. We've done a very poor job. We have 330 million Americans, 660 million shots, and we're woefully behind. We've got to get people inoculated so we can return to normal. And second, we have to figure out the resolution of the new stimulus package. Maybe 1.9 trillion is too big, but for those people who are really suffering out there, and there are many, both in small business and people way below the poverty line, they probably do need the extra $1,400 that President Biden has promised. So I think the economy is contingent on those two variables.
So we've seen a few 3 to 4% sized pullbacks for the S&P 500 over the last couple of months. Do you think that over the course of 2021, we'll see some bigger pullbacks than that, or is that going to be the norm for the rest of the year?
I'm not a technician. I think a lot of it depends on whether we can reopen the economy. I'll stick to the forecast I made on the Barron's Roundtable. I said the S&P 500 is a surrogate for the overall market, would be up 8 to 10% total return, including dividends. Through last Friday, we were already up 4.8%. So it says, yes, the market may be choppy, but I think the direction is still upwards. There's plenty of liquidity in the system. And, of course, as I pointed out, the Federal Reserve is being extremely benign in terms of the monetary aggregates.
So what does it all mean, Scott, for growth versus value? On one hand, you've got the NASDAQ up 9% this year, which is way outperforming the S&P, almost double the S&P. But on the other hand, you've got value groups like financials and energy at the top of the market for the year. So what does that say?
Well, actually, if you looked at the Russell 2000, the growth and the value, growth has slightly outperformed value year to date, and the same thing with the 2500 growth versus value. I mean, I can't predict which segment's going to do better. What we do is try to buy growing companies with upper earnings, strong balance sheets, strong free cash flows at low PE ratios, and you hope that that works. We're up over 10% year to date. We're having a very good year, and yes, we've benefited from the small mid-cap effect year to date. But look, if you go back over the last 2, 5, 10, or even 15 years, you'll see that growth has outdistanced value. It doesn't matter whether it's large cap, medium, or small. So it's difficult to say that this is the inflection point for value.
Scott, you picked out two stocks for us today, AdvanSix and Arrow. Tell us very quickly about each of them.
Well, AdvanSix is a chemical company that was spun out of Honeywell. It's a $25 stock with 28 million shares and a $707 million market cap, and the earnings are really taking off. We expect the top line to grow 11%, and we figure that earnings almost double this year. I projected $2.15 against $1.18. It's an 11.7 multiple. It's very cheap. Other chemical companies, medium-sized one like Eastman, sell at 14 times. Big ones like Dow and DuPont sell close to 20 times earnings. So I think you're getting a real bargain at 11.7. They're free cash flow positive. They'll generate over $45 million in free cash, and return on equity is 13%. The markets they serve are excellent at this point. Building and construction is number one. Ag fertilizer, because they produce ammonium sulfate. That's a very good one. And they make intermediate chemicals like acetone and acrylics, and that goes into solvents in the industrial markets. So I think they'll do well. They're able to pass along increases in their feedstock, which is a benzene derivative. They're not oil-based. They're benzene-based.
Shepard Smith here. Thanks for watching CNBC on YouTube.